Hello BCCA Semven Financial Accounting students. This is Assistant Professor Kailesh Muralidhar Jaitwar. Welcome you all in this lecture. We are in the middle of part 2 of Unit 1, and today's discussion will be on preparation of journals. How journals can be made, how we can pass journal entries. This is all about we will going to discuss in today's lecture. Let us have an example for this concept. We have seen that we had business and how we can manage that business, and although there are lots of transaction in our books, but the thing is we have to manage our books, our subsidiary books, our accounting books at a proper manner. So there is a very beautiful concept named journal entries. This is the scientific method to record and analyze transaction and summarize transaction in a particular manner with the arithmetical accuracy. So learners, this will going to discuss in today's lecture, and let's have an example. Let us have an example of a shop. We have a kirana shop, okay, a grocery shop, where we have lots of things, and in broadly we will not going to discuss the products in detail, but in very pilot study, we will going to record our transaction in a pilot way. That means in very summarized way, or not in very brief way. Okay, so you have an kirana shop and you are the owner, and as per the business entity concept which we have learned in previous lectures, what is business entity concept? The business owner and the business is separate, both are different entities. So you have to record your transaction not in your book, not in business owner's book, but in business book. Example, your shop name is all in one kirana shop. Okay, so all in one kirana shop will record the transaction. You will record the transaction on behalf of the all in one kirana shop. So let us have some example where from these commencements of business, how you can manage your books in proper manner. Let's say you have started your all-in-one kirana shop, and you have commenced business. Commence means starting of business. You have started business with some cash, where you will going to purchase kirana, and you have to sell to get a handsome amount of earnings. So here what your main business will be, you are bringing cash to the business, and you are purchasing some kind of goods to sell that goods. Okay, so you have to purchase to sell. You cannot sell before purchase, hence we have commenced business, and after that we will going to purchase goods, then we will going to sell that goods, and if we have appointed any employee in our kirana shop, we will going to pay salary to that person. Exactly like this case, we have some points on our board. There are 5 points we will going to discuss in detail with proper effect. We will first see, first we will analyze what is transaction, what are the accounts are included in this transaction, what type of account is this, what aspects it is what aspects are involved in this transaction, what rules means golden rules of accounting, debit and credit rules of accounting, what rules can be applied here, and finally we will going to prepare a proper journal entry, right? Let's start with a point 1, that is transaction number 1. Commenced business with rupees 50,000. Here you have commenced business. You have commenced business with rupees 50,000. You have to get capital. What is capital? Capital is the amount of money which you have taken into business to start business, to give a proper flow to the business, to put money in your business, to run business in a proper manner. This is all about capital. So this transaction is of bringing capital to the business. So we have a transaction where you means a kirana shop owner has commenced business with cash. Commenced business with cash means a person has taken has given 50,000 to the business. So what kind of accounts will be involved in this transaction? First, there is cash. 50 rupees is cash. It means there are two accounts. Cash account, and let us have a very detailed discussion on this transaction. You have provided 50,000 to business. 50,000 means rupees cash. Rupees 50,000 means cash. So one account is cash. And what will be the another one? The other one will be you, the business owner. Business owner means a person. Person means personal account. Personal account means your account. Example, Ram's account. But in this method we don't use the name of business owner. Instead of name of business owner, we use the terminology name capital account. Here two things are involved. First, cash, and the other one is provider of cash. Provider of cash means the owner of business. So we will not going to record transaction by the name of business owner, but instead of business owner's name we will going to put the terminology named capital account. We will going to use capital account instead of name of business owner. So here business owner's account means capital account. Two accounts, cash account and capital account. Okay, two things we have discussed here: cash account and capital account. Cash account is, we have three types of account: personal, nominal, real. Let us have a quick recap. Personal means person's account. Nominal means accounts for expenditure and losses, income and gains. And the third one is real account. Real account is for assets. So cash is asset for me. It is real account. Type of account: cash, real. Capital, as we have discussed just, capital account is the representative of business owner's name. That means business owner's name means a person's name. Person's name means personal account, right? And after analyzing two accounts, we have converted that two accounts in types of accounts. Now we will going to discuss what are the aspects involved in the transaction. Cash is coming or going. Obviously cash is going from business owner's pocket, and coming in the pocket of business, coming in the accounts of business. Here we have to record our transaction from the point of view of business and not from the point of view of business owner. For business owner, cash is going, but for business it is coming in. So here cash account aspect: cash coming. Okay, cash, real account, coming in. Okay, capital account, personal. So what will be the second aspect? Capital account means name of proprietor, name of business owner. Here business owner is receiver or giver. As per golden rules of accounting, there are three types of accounting: personal, nominal, real. Nominal says expenses and losses should be debited and income and gains will be credited. Other one is real account. Real account says debit what comes in, credit what goes out. And the third one is personal account. Personal account says debit the receiver, credit the giver. So personal account has two aspects, giver and receiver. So here capital account means business owner's name, nothing but business owner's name. So business owner will be giver to the business. No difficulties. Business owner is giver of the cash, giver of the money to business. Cash, real account coming in, capital, personal account, business owner is giver. Coming in, giver. Again we will discuss again in very short what is the golden rules of accounting. First, nominal account: debit expenses and losses, credit income and gains. Here for real account, debit what comes in, credit what goes out. Debit what comes in, cash is coming in, that means cash will be debited. Understood? Again, cash account is real accounts golden principle says debit what comes in, credit what goes out. Real account, cash is coming in, that means debit what comes in. What is coming in? Cash is coming in, hence cash will be debited, right? The other account, capital account, business owner's account, that means personal account. Personal account says debit the receiver, credit the giver. Debit the receiver, credit the giver. Here business owner is giver of the money, that means debit the receiver, credit the giver. Here giver means here we have to credit the personal account, credit the capital account. Capital account debit, capital account credit. Cash account debit, capital account credit. Again, cash real account coming in, debit what comes in, debited. Capital account, personal account. Business owner's account, business owner is here giver. Personal accounts rule says debit the receiver, credit the giver. Clear? From this we will going to make our journal entry. What I said, cash account debit, capital account credit. The way of writing journal entry is, please see, this is your first journal entry for your syllabus. First journal entry. Give very specific attention, very cautious attention, okay? Cash account debit. So how we can write this? Cash account debit. Cash account debit. Cash account will be debited by rupees 50,000. Why rupees 50,000? Because business owner has provided rupees 50,000. So cash account will be debited by rupees 50k. K means 1000, okay? Not Kailash Jaipur, okay? 50,000 means K. 50,000 means 50k. For 3 zeros we use K. 50k means 50,000. 2. By leaving some space here, you will start writing by giving some space to capital account. Here capital account 50k. Understood? Again, business owner has commenced business with rupees 50,000. We have two aspects, we have two accounts in this transaction, cash account, capital account. Types of accounts is involved here is real account and personal account. Real accounts golden principle says debit what comes in, credit what goes out. Cash was coming in, that's why we have debited cash account. That means cash account debited. The other aspects, business owner was the giver. Giver means personal account. Personal account, here we have used business owner's name. Here we have not used business owner's name. Instead of that, we have used capital account. Capital account comes under types of account. Personal account. Personal account, business owner is giver. Personal accounts golden principle rule says debit the receiver, credit the giver. Business owner was giver here. That's why it has been credited. And the final journal entry is cash account debited to capital account. Cash account debited to capital account. Exact in these ways we will going to learn journal entries for this transaction as well. Okay, understood? If you have not understood this thing, again rewind video and you can watch again this much part and you can understand. Okay, coming to the second transaction. Here what happened, you all-in-one kirana shop owner, that means you have purchased goods to sell. This is your operational duty. That means you have to purchase things to sell, by which you will going to earn income. Hence we have purchased goods for cash. We can purchase things on cash or on credit. That means if we have purchased goods and immediately paid cash, that means that transaction is cash transaction. And if we have purchased goods now but we are paying after some days, after today, if this types of transaction happens, that transaction is known as credit transaction. In Hindi, udhar ka transaction. Okay, let us have a very analytical view to this transaction. Purchase goods for cash rupees 10,000. That means there are again two accounts. First, purchase. Purchase means we have paid money. Means we have incurred expense. Purchase is our expense. We have incurred some amount which we have paid. That means this is expense. Purchase will be your first account, purchase account, and the other account is it is hidden in our transaction, cash. We have purchased goods in cash. Purchase expense, that's why this is the first account, expense purchase account, and the other account is cash account. Purchase account is expense. Purchase is expense. Expense comes under the types of account, nominal, personal or real. Please guess. Purchase will come under purchase can come under nominal or real or personal. Purchase is expense and the only account for the expense is nominal account. The purchase account is nominal account. And cash is real, as we have discussed in previous transaction. Purchase account nominal, cash account real. We have discussed that what is the rule for cash. Now the new thing for us is purchase account. Purchase is our expense. This comes under types of account. The types of account of purchase is nominal account. The golden rule for nominal account is debit all expenses and losses, credit all income and gains. That means account of purchases, purchase account will be debited. Why? Nominal accounts golden principle says debit all expenses and losses. Purchase is a kind of expense. That's why here purchase is Purchases are expense. Purchase is expense. And real account, cash is coming in or going out. Cash is going out. Cash is going out means we have paid some amount to someone. That means cash is going from business. Cash is not the particular amount of cash, rupees 10,000, will not be in our account. That amount is going from our business. That means cash is going out. Cash going out. Going out. So again, purchase account nominal. Purchase account comes under nominal account. Nominal account, in nominal account, purchase is a kind of expense, and nominal golden rule for nominal account is debit all expenses, credit all income and gains. Debit all expenses, that means purchase account will be debited, and the other account, cash real account, cash means here cash is going out. Note, going out. Here that was coming in, that's why debited, and vice versa for this case. Cash account going out, cash is going out. For real account, this cash comes under real account. Golden rule for real account is debit what comes in, credit what goes out. Here cash is going out, dear friend. Okay, cash is going out. Going out means cash should be credited. Debit what comes in, credit what goes out. What is going out? Cash is going out. That's why cash is credited. For this, accounting entry will be, journal entry will be purchase account debited with rupees 10,000, with rupees 10k. 10k means 10,000 to cash. Why? Because cash is going out. Cash account. This is our two transaction. We are making videos very short because we are taking particular transaction in very detailed and analytical way. That's why videos is becoming more lengthier. Hence, to make video short and to make very convenient to you to watch, we are making video very short. Okay, so these three we will going to see in next lecture. Okay, for these two, let's have quick recap. We have, that means all-in-one kirana shop owner commenced business with rupees 50,000, where he given 50,000 rupees. He means business owners given 50,000. There were two accounts involved: cash account, capital account. Cash account, why cash account? Because 50,000 is cash. Cash is coming in. That's why cash account. And capital account means, capital accounting is nothing but owner's account. Cash account, real account, type of cash account is real account, and for capital account this is personal account. Golden rule for real account is debit what comes in, credit what goes out. Cash was coming in, hence we have debited cash account. And business owner means personal account. Personal accounts golden principle says debit the receiver, credit the giver. Business owner is given here, that's why we have credited business owner. The combined entry for these two aspects will be cash account debited to capital account. The other transaction is purchase goods of rupees 10,000 in cash. There are again two accounts, purchase account and cash account. Purchase is comes under nominal account because it is a kind of expense, and golden rule for nominal account is debit all expenses and losses, credit all income and gains. That's why purchase account has been debited, because purchase is an expense, and golden rule for nominal account is debit all expenses. Hence we have debited purchase account. The other account is cash account. Cash again is real account, and cash is going out. And golden rule for a real account is debit what comes in, credit what goes out. Here cash account was going out, that's why we have credited cash here. And the combined entry for this transaction will be purchase account debited to cash account. This is all about two transactions. We will going to see these three in next video. Okay, till then, thank you.